Over the past few episodes, we've unpacked some of the biggest post-M&A challenges the Portco executives face, from operational hurdles to financial inefficiencies, and trying to really help companies turn acquisitions into sustained long-term value. And now we've reached the final episode of our Continual Value Creation mini-series. And we're closing it out with a topic that directly impacts every dollar earned, and that is accounts receivable and collections. You can have strong sales, you can have great service, but if your collection process is broken, you're really literally leaving millions on the table. Add an acquisition into the mix, different payment terms, disconnected teams, outdated processes, and suddenly what should be a routine function becomes a financial bottleneck. So today, in this grand finale, we're breaking down the biggest post M&A collection pitfalls and really work through how maybe you could think about fixing them. I'm Yassin Shaar, CEO of Origo, joined by my co-host Gyner Ozgul, CEO of RafterX, along with Symeon Gum, SVP of Transformation at Origo. Let's dive in. Gentlemen, welcome to our grand finale. How are you doing today?
Good.
Very good. Good to be here.
Yes.
I don't know. Is it really a finale or just the first part of something bigger?
Well, could be. Not letting the cat out of the bag just yet, but we've definitely got a lot more coming, and this conversation has been super helpful, and the feedback, I've been talking to quite a few folks in my DMs about different things they're seeing in private equity, especially in field services in private equity, and it seems that like this topic is definitely resonating. And we've got unique audience tuning in. Operating partners from private equity, Portco executives from in private equity and across field service companies. So there's probably more to come here, Gyner. Wink,
Yeah,
wink.
absolutely.
One finishes another start, right? So let's.
Exactly,
Good.
and it's always good to talk about cash flow, right? And this is what it's all about. So, Gyner, I'd like to start out with you. Since you've got extensive experience doing M&A, over 30 acquisitions in the last 5 years or so. What is the state of accounts receivable across some of the acquisitions and the partnerships that you've made? Are they running like a well-oiled machine? Do you typically find some low-hanging fruits there to pick up a few millions a year in improved cash flow? Like, what's kind of the state that you typically come across these AR processes once you've partnered up with a new founder and that joins your platform?
I'd say it's a little bit of a mixed bag, right? And here's why. It's you've got a lot of founder-led or entrepreneurial businesses that are cash-based accounting systems typically. And to oversimplify, in those types of businesses, typically the owners focus, not all owners, to be fair to the owners that are going to listen to this, but a lot of owners essentially, as long as there's good cash in the bank, essentially to operate their business and fund their draws, they don't really think about AR the way a kind of functioning accrual-based business thinks about AR, right?
What's the difference? Can you explain the difference to us? At least in the mindset and how you look at it.
The way I look at it is, in a functioning accrual-based business, we need money. We need the accounts receivable to get as close to the terms as possible in order to maintain cash flows within the business, so that you don't have to go borrow, you don't have to go pay interest payments, right? Essentially, you're really looking at using the cash in the business to fund the operating needs of the business going forward, right? And it's a little bit of a different take when you're an entrepreneur. Now, it's not a shot. I probably do the same thing, right?
Yeah.
It's just your focus as an entrepreneur is growth, customers, right?
Yeah, as long as you wake up in the morning, you open up your Wells Fargo or JP Morgan Chase,
right.
and you see, double digit, triple, whatever makes you comfortable, you're like, I'm good.
And you're growing, and your customers are happy. It's all good, right? It's an
Right.
oversimplification, but it kind of resonates with, and
Mm.
that's what they should focus on, right? Because otherwise, what are they selling when they want to go monetize their business? They're going to sell revenue and EBITDA or some variation thereof. Yes, the cash is important within the net working capital, but we assume some of that risk in the deal construct, right? But to answer your question, it's a mixed bag. Some of them are really good. If they have very good verticals in terms of how they sell and who they sell to, that usually means their process innately is a little more streamlined on the collections. If they sell to a swath of end markets, typically their correct collections are a lot messier, right?
Mm.
So that you find all this variability in their collections processes, and it's typically a share of someone's job who does something else within the organization as well.
Mm.
So it gets a little complicated. Maybe Symeon, you could fill in the gaps a little bit.
Well, no, I just agree with everything you described, Gyner. And then the problem is when you get to the collection stage and you're trying to get the cash for all the hard work that you've already completed and moved on to another customer with, right? You're dependent on other parts of the organization. Your last point there about the collections is oftentimes, especially in an entrepreneurial company, it's a part of somebody's job. And yet, when there's a dispute or when it's not as simple as, oh, I forgot to pay you, okay, here's your check, and you have to run information down back to the original call, to the original dispatch, to the original order, to the original not to exceed, the amount of time and the amount of effort required in there, it's just, especially in a growing business, but we've got new customers that we need to take care of. It's very difficult to allocate the time to follow through on them.
Absolutely. And as
Yeah.
a platform with an aggressive M&A strategy, what are the negative implications of not keeping a very close eye on your AR? And you kind of a little bit touched on it there, Gyner.
Well, there's typically some level of, when you first buy a business, there's a little bit of a risk mitigation that's put into the net working capital kind of adjustment. So if they have too much outstanding accounts receivable, you're making kind of an assumption in the net working capital plug with the owner. Essentially, there's an amount in escrow that could be penalized against the owner if that AR is not collected within a period of time. Typically, it's about
Interesting.
it's 6 to 9 months, right? If they have $1 million of AR and 600,000 of it is past, let's just say 120 days, there's usually that kind of a stringent definition. It says that plug of $600,000 has to be collected by the time we true up the networking capital for us to release escrow to you, right?
Wow. Okay.
And if it's not, so at the end, and typically, look, just to be clear, people are pretty fair in these things. Like if they
Yes.
collect most of it and there's some lingering ones at the end, we typically don't
Of
ding.
course.
We're not looking to give penalties to owners. But if it's 600,000 and it only moves to 500,000, there's going to be a different discussion at the end, right? About, what did we buy in terms of AR? I think once the businesses are integrated, what you need to be careful of is, I said something earlier, that person, this is a share of mind for them. They're doing this with other jobs. And if you don't recognize that in your process, your movement of the process, or your change or migration of the process, or integration, whatever word you want to use, you're going to miss something, and it's going to get worse for a period of time, because that knowledge base, you lose it. And now all your new people have to learn your process and learn all the stuff that was around the sticky notes of that person's monitor that now you don't have anymore, right? So you have to be very careful to understand, what else does that person do? How do we protect that person, especially while we're trying to migrate and improve the integration process as it pertains to AR.
Okay. Just talking about, go ahead, Symeon.
No, I was just thinking that conversation, right? It sounds like our other episodes too. So recognizing that collections, that this part of accounts receivable is a process like all the other processes. It's at the tail end and might not be a full-time job for somebody. And so just like we have to hang on to our dispatchers, and just like we want to hang on to our technicians, and just like we have to understand, the legacy of our account managers, the collections piece is something to be very aware of as well, and to spell out specifically.
Yeah, absolutely. So, and maybe let's dive a little bit into some of the breakpoints or the breakdowns that you typically see in AR. Definitely we see a lot of that when we're integrating with, typically we have if a mature platform has shared services function that facilitates, accounts receivable for all the different locations and acquisitions, and we're doing an integration. One of the biggest pain points that we typically see on our end when we do, like you said, a knowledge transfer or an integration, is just outdated customer data. The records, man. It just you can almost there's at least half of the records we come across are outdated. We either don't have the proper AP contact, or if we do, we don't have the right number.
They moved their office, right? They got acquired.
What I will say though is there's a level of detail that the organization needs to kind of have ownership of in that. So like what I'll say is yes, you're right, but there's an and there, and the and is you're getting checks typically in your unapplied cash from these same customers, right? And you're not looking at where those checks are coming from and who they're coming from. So you're a big conglomerate, end market food service company. I don't know if I can say names or not. So the ones that run hospitals and universities, and you go to a university, there's hundreds of kitchens and kiosks and coffee shops, right? And maybe they haven't paid you at this coffee shop kiosk for some reason on that coffee machine you repaired, but you keep getting checks about the main kitchen, right? You're losing an opportunity to put those two together in the organization.
You're looking at it as an account, one account. You're not breaking it down into sub account.
And typically that's where your complication comes in, where you have kind of a one-to-many relationship in a campus setting, because somebody isn't doing the reconciliation with the end customer themselves. Like once a quarter, you should say, hey, I've got $10,000 of unapplied payments to your $40,000 balance. I see for some reason these 5 locations haven't paid us. Are some of these payments for those locations? Or would you like me to apply some of these payments to those oldest, outstanding invoices of those locations and send you kind of a net of outstanding? Now you got to be a little careful, because the customer needs to go through and say, hey, I think I paid all these already. And then you should really go through the exercise of saying with the customer, got it, your $10,000, you send me a list of 20 of these invoices on your side you've paid that I show still open. I'm going to take a portion of this $10,000, apply it to those 20 invoices. So now we're both correct. Now I have a net left, $4,000, right? What do I do with this, Mr. Customer? I can send you the check back, or I can apply it to the oldest invoices, send you a list, and you close it on your side and I close it on my side. And then I'll send you a new net open outstanding AR list, right? It should be that regular, a reconciliation with the customer, and location by location by location. If you let it get too big, it's too hard to clean up. Then you're negotiating settlements.
And you're doing an acquisition every month, every other month. And that one conversation multiplies by hundreds, thousands.
It becomes a project, right? You have to run it as a project.
Quite literally what it becomes.
I will also say sometimes, pride can get in the way of arithmetic. Okay?
What do you mean by that?
So the idea that, okay, now you've lost some of the control of it. As a leader, myself included, at some point you got to draw a line and say, okay, enough. We are where we are. Here's the top 25 customers. They're making up 80% of our outstanding AR. We have a whole bunch of unapplied cash. We're going to go to those customers. We're going to say to them, let's negotiate a settlement to get you current, including your unapplied cash, and get our
Open up a
books
new
clean,
thing.
and you get your books clean, right? Yes, you're going to take a hit. You are going to take a hit, right? Because the settlement means you're going to have to write something off. But what I would argue is the amount of interest payments you are making today for that cash not being collected and having to borrow in order to maintain your cash flow in your business is going to be a little bit of a push, right? And if you don't do that arithmetic, that's my point, pride arithmetic. If you don't do that arithmetic that says, hey, you know what? I'm paying 11 to 15% interest over here. If I just wrote off 8% with the customer because I'm out of control right now, I'm still a little better than the interest I'm borrowing. I get my AR cleaned up, and now I have a new process to keep the discipline in place, right? But the pride of trying to fix it transaction by transaction, that can be absurd. And you know what? You're gonna kill yourself with that pride and kill the business.
And not keep a good relationship with the customer either, right?
That's right.
And flogging your way through each transaction.
Yeah. Oh, well, that's a big takeaway. So, and Symeon, over the last 3 months, we've been working quite a bit across multiple instances where we're looking for, or we're finding, optimization or continuous improvement opportunities. Based on your experience and and what we've been working on in the past few months, like what are some of the more common pitfalls or breakdowns you've uncovered or picked up on as a recurring issue you're coming across in AR?
But just the lack of regular visits or regular viewing of the aging report, right? The follow up. And then one thing I was thinking as Gyner was talking too is you're kind of, Gyner, you were sort of describing like, well, what is your formal process for writing off bad debt, right? When do you say, hey, we're not going to collect on this? We're either going to take the hit, or we're going to send it to a third party collections, or we're going to negotiate with a good client or a good customer to have some kind of a settlement. And just in the last couple months, even Yassin, looking at some of our clients at Origo, and they have no formal way of addressing that, and it turns into a customer by customer. Well, how do you want to handle this one, right? And then one thing I think in a separate conversation, Gyner, you mentioned, then you got some of our clients, they have mechanics liens. And so, this is a big project, and it doesn't look like that because they're mainly service. But then they have a really big project that is maybe a multi-tenant, right, housing development that's spanning like 18 months or 2 years to complete. And so they've got a lien on the property. And yes, it's been 2 years and they've not collected, but you don't want to write that one off, right? Because there's so how much legislation do you want to get into, and when do the lawyers get involved? There's a whole nother cost that you have to factor into your arithmetic.
That's right.
Absolutely. And so, and how do you talking about shared services and AR being one of 10 jobs, but now they're integrated into your business. How do you think about AR? Do you centralize it? Do you keep it localized? Is there a hybrid approach? How do you think about standing up a high performing AR department that's actually focused on making sure that your DSO doesn't go wild and off track, Gyner?
So I used to be a centralized guy on this. I have a little bit of an evolved thought on this. You should collect the way you sell. So if you sell nationally, then you should collect nationally. You have a sales team, and you should have AR specialists that are aligned to the sales team and aligned to a customer. If you and by the way, I'm saying this because in PE there's like different variants of this that happen, right? If you sell locally, so you're kind of a house of brands strategy, So you have a parent and then you have a whole bunch of children across the country, and maybe they're integrated from a system standpoint, but their value propositions in front of their end customers or their local markets is still very not integrated, which is okay. I'm not being critical of that. Then that's how you should collect, right? Because you create a little bit of a disjointed process if you say, I'm going to centralize AR, but I'm going to continue to operate in pods, right? So the customer's got like this very, very high touch local customer experience where the dispatcher knows them and the salesperson visits them and they know all their techs and they got a little office, and yet you got this collections piece that's off somewhere else. And to the customer, that feels disconnected, right? And it shows up in your AR process. Trust me, it does.
Interesting. And when you say it shows up in your AR process from a customer experience, that is, or
it's just worse, because what you've done is you've created the complexity unintentionally. You didn't do it on purpose, because you're like, oh, centralizing totally makes sense, right? Because I can streamline it and save 3 headcounts in doing it this way. But by having it decentralized, because that's how you sell with your customer, there's a value that you have in terms of accountability at the local level of, the dispatcher, the technician, the salesperson, the AR specialist are all aligned to making sure that work order, that invoice are correct and collected for, right? But if you take those first 3 roles and they're local, and you take that last role and you put it somewhere else, the accountability is really difficult to drive right back to that technician and dispatcher and say, hey, the customer's disputing this trip charge. They said that you told them you're not going to charge them for it. What happened? Right? So I know that's a little like really granular, but sometimes you have to start to think about the organization of your business is really important to understand, because the organization of your collections and AR has to be aligned to the organization of your business. And don't be so short-sighted to say, hey, I'm going to get synergies by taking out a couple of people, right? And by the way, that doesn't mean you can't outsource. Origo is a great outsourcer for us, right? It just means your outsourcer should be part of that local team then, as opposed to trying to do the whole aggregate.
Yeah. And the way you can think about it, if you want to free up the team, maybe you can look at the non-client facing aspect of that function or of that process, and free up the collectors to focus on the customer interactions instead of the admin side. So I love this. So this is a big key takeaway here. Collect like you sell, and align your collections with the sales and the customer service team, and for consistent customer experience and for better cash flow. So I love that. And how do you start thinking about standardizing payment terms, and aligning contracts, right? Because every business typically, more or less, there are general guidelines, whether it's net 30 or 45, or if you're working with a chain customer, and so forth. How do you navigate this payment terms and alignment of contracts?
I think the question is, when you negotiate your so let me rewind that. When you say payment terms and contracts, I think of it a little differently, right? So your generalized customer should always be net 30. Sorry, they just should be, right? If you're giving anyone else more than that 30, that's just your normal street customer. You're doing your business a disservice. So I'm going to be very
you're turning into a bank.
Yes, and you're not a bank, right? And I would even argue for customers that are not contracted or use you sporadically, you should be taking payment up front, like a credit card, a temporary hold on a credit card, which you can do, just like they do when I go buy gas at a gas pump. They put $1 on my credit card as a pre-auth, right? And for everyone else, you should negotiate the terms that align to your business need, right? So if it's a very large customer and they want net 60, which is very likely the case with larger customers, they're going to try to draw out terms on you, because on their P&L, they are making money on the money sitting in their bank for longer periods of time. They're a business as well, right? And the larger the business, the more they're going to try to draw you out. I always think about it as there's a little 80-20 in there, right? So they're going to tell you 60, and they're going to pay you 60 on 80% of their volume, and they're going to pay you on the last 20% something more than 60 days. Could be 83 days, 90 days. So in your calculation, you should penalize whatever your final term is and understand that that's probably going to happen, right? So in this case, using simple math, if it's 60 days, it's really going to end up being 72 days. So I'm adding like a 20% penalty to that, 12 days, right? And assume they're going to end up on a median or average of 70 to 72 days, right? When you peg them at 60. If you want them any sooner than that, that's okay too. Then negotiate a lower number, knowing that they're going to hit a target for yourself, right, internally. And that should be defined in the agreement. There should be an agreement because you're pricing, and make sure the customer understands pricing is tied to payment, because they don't make that connection, right? The discount I'm giving you in price is directly correlated to the fact that you're going to pay me in 60 days. So if you want to pay me in 80 days, then your pricing has to change, right? To reflect that. So you have to have that conversation and make the correlation and call it out, because they're not going to do it themselves.
Absolutely. And Symeon, you've been going in and out a little bit.
Yeah,
but
apologies. Technology.
no worries. But what I want to maybe explore with you is, when we're looking at collections and AR, like what are some of the key metrics that you're looking at, whether it's efficiency, defect KPIs, or like what are you mostly concerned about, or like what are you trying to look at to troubleshoot or diagnose, and try to find areas for opportunities?
That's a good question, Yassin, and I was just having that conversation with our director of operations, because we're looking at collections and saying, okay, what does a defect-free collection look like? Because arguably, it's already a defect because they didn't pay, right? So we're into the collection space. But then we said, well, what is the transaction? So the transaction is a collected payment, or at least a resolved one. So we either write it off, or we're collecting it, or we're settling. So something is happening there. So the measurement becomes very difficult. It's not the number of phone calls made. It's not the number of emails sent. Instead, it's the efficiency, the amount of effort. We really want to track the effort required to collect each dollar, right? So there's almost a measurement there, as far as like, well, okay, so we're collecting something that should have just been paid. How much are we paying to now try and get that dollar? So there's a measurement there as far as the effort involved, and that's why you want to break out those activities separately, so that you can truly track the cost of your collection effort.
Absolutely. So already, you think about, I'm not diminishing, the role of AR in collection, but it's almost the fact that you're having to collect on something is already considered in lean terms maybe a defect, and beyond that, you're continuously paying for that poor cost of quality, or cost of poor quality rather, because not only now you have overdue AR, but it's actually continuously costing you money.
Costs, right? Yeah. When does it stop?
And I think on the last episode we talked a little bit about this. This is where you got to get people into a room and figure out what's going on too at some point. Like, because there's going to be common themes across customers, like, hey, this charge, we're getting a lot of dispute concerns about this line item, or we're writing off a lot of return trip charges, or the parts markup is $5 too high, or whatever it is. Your billers are going to give you some pretty consistent feedback. Even if it's qualitative, it doesn't have to always be on some big spreadsheet. Just interview your billers. They're going to be like, yeah, every time this company calls me, I have to make sure I write this off, or they're not going to pay the invoice. Well, then either change your process to be okay with the fact that you're going to write that off and keep the business, or go upstream to the customer and the salesperson and have the conversation.
So there's the Gyner just did the root cause analysis, right? So we've got the collection, the fact that something needs to be collected. That's effectively a defect, but a defect of what? Well, the first degree of separations is a defect in the bill, whether legit or not. There's some reason why the customer, you generated the bill. That was a different process. So we sent the bill to the customer, assuming that they received it correctly and that they got it on time. It went to the right address. Back to that conversation, right? Then, if you're going to address it, well, we could keep making phone calls and resolve it every time and change the address every time and remail out another invoice. Or we can go back to the root cause and say, well, what in the billing process, just like I'm just repeating what Gyner said, but just like Gyner talked through, what in the billing process is falling down and causing this difficulty in their paying?
Yeah. To your point, because in collections and AR, really, you're dealing with process breakdowns, upstream, right? Whether you don't have you didn't have the right terms, or you set the wrong expectations, or you didn't collect the customer information, or for whatever reason there was something broke down on the way to service the call and the technician didn't show up, but you still billed the customer. Or when you billed the customer, there was few line items that had some errors in it, and you're having to deal with all of that process breakdown and inefficiencies downstream, and that's where it all piles up in AR and collection. And there's a lot to go into, from mismatched payment terms to disorganized customer data, lack of standardized collection, and increased DSO. And I think we can go days and days or episodes rather, just going into the how you can really stand up a high performing AR function. If that's an area you'd like us to dive into further, let us know in the comments, and maybe Symeon and I can maybe do a little bit of a more deep dive and take a few use cases of what we're seeing, obviously anonymized, of what we're seeing behind the scenes, working with a lot of field service companies in private equity, on how they're turning around their DSO and bringing in cash flow faster. But look, we've covered a lot throughout this series, navigating post-M&A integration, streamlining operation, unlocking hidden value across different functions from order to cash and AP and all. And as we wrap up, I'd love to hear from both of you, Gyner and Symeon, like maybe what's the one lesson or principle from this series that you think every portfolio executive should remember when it comes to creating sustained value post an M&A integration beyond the acquisition? What would be the one lesson or a key takeaway or advice to our listeners?
Let Symeon go first.
Okay. I think we've broken it down. We've had separate episodes on the different topics, but they're all part of the order to cash value stream, right? And so often we can, if we're an acquirer, if we're a founder, we think, oh well, here's what I need to work on, but every single step in the end-to-end value stream can be improved. It's a matter of prioritizing. And it's a matter of how much time you allocate to the different steps. So I think it's important to, in the course of making improvements, in the course of trying to resolve problems, to be able to also step back and see, okay, I've resolved it to some degree over here. Is my bottleneck, is my larger issue now in a different part of my value stream? And so being able to have everything in context. We've had separate episodes, and we can even deep dive even further, like you described, Yassin. But always step back, always look at the total end to end, and keep assessing to see if you're working on the right spot.
So to summarize, think in value stream, not in steps. Value stream thinking, and that's something that we are embracing at Origo wholeheartedly, and not just about our value stream, but the value stream of our clients and the end even client, because you're really delivering value to, there's not one stakeholder you're delivering value to. There are multiple stakeholders that you're delivering value to, and and each has their own value stream that just so happen to overlap in that process or life cycle of delivering your service. Phenomenal takeaway, Symeon. Gyner, what's one advice you would give your fellow colleagues, CEOs, and C-suite?
Don't look past the obvious, because sometimes we get a little complicated. Like, look at this discussion we just had on collections as an example.
Right.
The obvious is you got kind of a messy problem right now. Maybe you're at 100 days with a customer or something like that. In terms of collection days, like, you're gonna have to go negotiate a settlement. You're not gonna go review all those invoices. You can't, right? So stop trying to get past the obvious answer that's in front of you. Like, go negotiate and solve it. The other advice I can give, and that's just an example, right? There's plenty of others in this series you can go back and listen to. The other one I can say is, like, be decisive. Like, make a decision. Because every day you don't make a decision or look for resources like Origo or somebody to come in and help you fix the problem, you're just delaying the inevitable of the first one I just said, which is now you're going to have to go write off a bigger chunk of money at some point to really kind of course correct yourself in one swath, because you didn't make a decision now when you had the problem and said, I'm going to resource it properly, I'm going to find the right partner, I'm going to find the right expertise, and I'm going to go chase it like tomorrow and do it aggressively, right? Make those decisions. We owe that to the people in these organizations as we talk about things like integration, work streams, value creation, all the buzzwords that make them feel good when they first meet us. Our ability to make decisions will determine whether or not they believe it. So make those decisions and find great partners, such as Origo.
Well, and that's a wrap for our continual value creation series. And really, for me, if there's one takeaway from this discussion, is this: look, value isn't created just at the deal table. It's built through execution every single day, relentless execution, whether it's streamlining collections, going into billing, addressing customer service issues, improving integration. Really, the companies that thrive post M&A are the ones that get the details right. And Gyner, Symeon, I'm very grateful for all the insights you've shared with us and our audience. So thank you both for being such a big part of this series and sharing your insights. It's been an incredible conversation, but we're not stopping here. In our next mini series that we're calling it FXL Masterminds, we're going to go a little bit outside of the order to cash and a cycle or value stream, and really talk to different M&A practitioners and operating partners on on the state of field service in private equity, and how do you go about the next 3 to 5 years. They're calling it the golden years in private equity. So how do you make the most of it and make sure that this golden era doesn't end without you amassing massive wealth for yourself, for your partners, for your private equity, for your community, and really leave a big impact on the industry. So for more insights and more real world lessons and more strategies to help you stay ahead, make sure that you stay tuned, and until next time, keep building, keep optimizing, and keep creating value. Gentlemen, thank you so much, and Gyner, I'll be seeing you on the next episode.
Look forward to it.
Thanks,
Thank
guys.
you.